Really, this is quite a big challenge, putting two organizations of this size together. I mean, in total we have 15,500 employees, just to give you a sense, and we have got extensive integration programs across all the divisions. We've got 6 different divisions, each of them with different milestones and so forth, but what we decided to do is to appoint the Chief Integration Officer really to oversee the process, and we've got very strict targets. One of the clearly measurable targets is the expense savings, the savings that we extract from putting things together and becoming more efficient. And there we're very pleased to have achieved expense savings of 201 million over the year, which will be of a recurring nature. And in fact, that exceeds our target of about 180 million for the current year. So quite a milestone that we've achieved there.
What has been the biggest, hurdle to integration?
Yeah, look, it's difficult to change things, by people's nature. They really resist change in the normal course of events. So you really need to have comprehensive change management programs to really take the people along. So clearly you need to set a vision for a new organization, a combined organization that staff buy into. Once they understand that vision, they want to know where they fit in. What is my role in this bigger picture? So there we sort of very clear to have certain milestones, practical targets for people and so forth, really to make this whole organization a better organization. So really the people management side, I guess, is as tough as the normal business side of it.
In a nutshell, what is the vision for the new MMI Holdings?
Yeah, essentially what we want to do is we want to be a leader in meeting the financial services needs of our clients. So really our clients come first. Everything we do, we center on the clients, and everything we do every day, we need to satisfy their needs or meet or exceed that, either through our product offerings, through our service offering, all our interactions.
You talk about there being signals of consumers under pressure in South Africa, consumer confidence low, debt levels creeping up once again. We saw that in the SARB's quarterly bulletin yesterday, where debt to disposable income ratio creeping up. Where's the pressure most evident across your various group earnings?
Yeah, I think that's a very interesting observation, because we are sort of a very diversified group. We play in all the different market segments, and we've been experiencing some pressure, in fact, across the various segments. We actually surprisingly grew the fastest in the lower segment and experienced most of the pressure more higher up, with the higher income segments. I think the recent change in the fuel price, for example, will really impact some consumers negatively. Clearly, the low interest rates help, but it's not sufficient to really compensate for the increase in the basket of expenses of individuals.
Let's move through the various divisions. Metropolitan Retail operating profit up 11% to 438 million rand. Value of new business slightly increasing to 262 million rand. Talk to us about the strategy here in light of the fact that you've in fact change the mandate here, and you want to take on a less risky profile. How's that going to impact earnings?
Yes, Metropolitan Retail is focusing on the lower end of the market, the emerging segment of the retail market. It's really a very well-run business, a high volume, low-cost business. And the business has been very successful to achieve excellent margins. The margins on new business there, almost 5%. Profits up 11%, but in fact there was an increase in the tax charge. If you look at the pre-tax profit growth, that was in fact 17%. So very, very solid business, and understanding that market segment extremely well.
When it comes to that less risky mandate, what is that going to do to earnings?
Yeah, what we've decided to do is to have a more cautious investment mandate for our shareholder capital, and that specifically was a big change for the Metropolitan business compared to the past. Essentially what it will do, it will reduce the volatility of earnings and give us a much more stable income flow as we earn sort of interest returns on the cash or near cash type investments, and really isolate us from the volatilities of the equity markets.
Momentum Retail operating profit up 40% to 1 billion rand, but the value of new business falling back to 207 million rand. You did write 23 billion rand in single premiums during the year, margins falling back, however, to 0.7%. So of course we've seen an increase in operating profit, but the value of new business falling back, and the new business margin obviously falling back to 0.7%. Yes. Why is this so, and where's the margin squeeze coming from?
Yes, Samantha. At the upper end of the market, where Momentum Retail is focusing, there's a lot of competition. Most of the business is written through independent financial intermediaries where they really shop around for the best deal, and clearly many of the clients very sophisticated. Also with a single premium business that you mentioned, we wrote 23 billion rands, as you rightly point out. It's a huge number, but those products have very, very low margins by their nature, and a lot of competition in that segment. So the margins there will always be lower than at the lower end of the market. Our target over time is to really try to achieve a margin of 1%. We're slightly less than that, but we, through cost efficiency, want to get there. I think it's worth pointing out the operating profit is a very good performance. I mean, in excess of R1 billion, which is about a third of the total group earnings. So clearly a very, very important business here. The good performance was supported by sort of good experience profits, good expense management, but also there's some technicalities in there where we started to take credit for returns on certain of our reserves, given the capital efficiency of that business. So it's a solid base to grow from that R1 billion of profit.
You talk about the unpredictable nature of markets at this point in time, hurting Momentum Investments, where operating profit fell back by 5%. Have you identified the problem areas? Do you have a new strategy with regards to dealing in a new world where markets are volatile and you've got low returns at this point?
Yes, for the Momentum Investments business, we are in a rebuilding phase. In fact, we have had a management change in that business too. We're actually very pleased that our Deputy Group CEO is able to dedicate a big percentage of his time on that business, really to help us with the rebuilding phase and essentially to confirm the strategy for a longer term turnaround. At the end of the day, the most critical deliverable there is solid and superior investment returns. We still have some way to go in some pockets, but there are other pockets where we're already there, like our fixed interest performance is excellent. Our equity performance on those portfolios, that's improving. So I think we've got some very good sort of building blocks, but now the Willem van Zyl will help us to take that to the next level.
Of course, you know, a special dividend, a nice return for shareholders during the period, 65 cents per share, equating to around R1 billion. Why are you choosing to put your capital to use in this way?
Yes, I think that's one specific feature of our current results that the analysts and investors will be very pleased with, is the special dividend of R1 billion. What we've done is we've looked at our capital management program, we've looked at the strategic initiatives, we've looked at the capital requirements, and in fact, even after the special dividend, we still have a capital buffer of R3.3 billion. So the company is still in a very solid position. But we also felt it's fair to really return some of the capital to shareholders, and because the opportunity cost of sitting on more and more capital is not good for shareholders, and it really, I guess, sends a signal that we are happy to share some of the benefits of our capital programs with shareholders over time. If you take the special dividend into account, in fact, our total dividends for the year grew by 41% compared to the prior year, which is a dividend yield of in excess of 9% on our embedded value. So it's a fantastic running yield, and at the same time we're starting to grow the business nicely in addition to that. So I'm sure shareholders were very happy.